Now that we've overviewed the statement of cash flows so you know what's involved, I'm going to spend some time talking about creating an indirect cash flow statement. The first step is to determine the change in cash. Take the starting cash and subtract the ending cash and basically determine what the change in cash has been. So that's step one, and that's a great start because you get to know the answer in advance. You know what the cash was last year, you know what the cash is at the end of this year. That's your change in cash, and everything else you're doing has to add up to equal that. So that's kind of a nice thing. You get the answer in advance. Now, the hard part is really section one, which is determining the net cash flow from operating activities. And you start with the net income, which is pretty straightforward. You pull the net income off of the income statement and you put that at the top of your statement of operating activities. Then you start adjusting and you put in the items that do not affect cash, so depreciation, amortization, you adjust in there. You do your changes to your working capital accounts. Those are more difficult because you have to know what is use of cash and what is a generation of cash. The increases and decreases matter as far as that goes, so that can be confusing. The key thing to think about here is when you have extended cash to somebody or extended credit to somebody as opposed to collecting cash. So if accounts receivable has gone up year over year, that means that you've extended them more credit and taken in less cash. So if accounts receivable goes up year to year, well, that's a decrease in cash. But if your accounts receivable goes down year over year, then that means that you have been collecting more aggressively from your customers. And so therefore, you've generated more cash. That's a positive impact on cash. So the assets go that way, and then of course the liabilities go the other way. When you have accounts payable increases, that means you're taking good advantage of your supplier's credit, and so that's a positive impact on your cash. Whereas if your accounts payable has gone down year over year, then that's an indication that you are not using your supplier's credit effectively, you're paying them more, and therefore your cash has gone down, or there's a negative impact on cash. So that's what to remember when you're working through your working capital accounts. That's probably one of the trickier parts. And then finally, in that last part of section one is your adjustments for non-operating gains and losses. And you can see some examples here in the TELUS statement of cash flows. Once you've done the net cash flows from operating activities, you're in pretty good shape. All you need to do now is section 2 and 3, which are much easier. Investing activities and financing activities. And you can see here, as far as TELUS is concerned, these are pretty straightforward. They have pretty straightforward components. There's not a lot going on. There are fewer lines in these sections than there is in the operating section. One of the tricky things, and I don't know if you'll be seeing it or not, but I wanted to just mention, one of the tricky things is whether or not depreciation and amortization has been considered when you're looking at your capital equipment additions. So when you are looking at the investment in capital assets or cash payment for capital assets in the TELUS statement of cash flows, it would be wrong for us to look at the balance sheet of TELUS and say, okay, property, plant, and equipment, there it is on the balance sheet, 9,123,000,000, subtract 8,420,000,000 last year, and there we have the cost of the additions for 2014. That would be incorrect because you have to remember that that $9,123,000,000 line for property, plant, and equipment has been reduced by amortization. So yes, additions were added to bulk up that number or increase that number, but amortization has been taken off of it. And when you see a statement like TELUS's where there's not a separate line for accumulated amortization, then you can make that mistake. That is not the case generally speaking in the text. Generally in the text you've got a separate line for accumulated amortization, but sometimes you don't, so just keep that in mind. In the next video, we're going to be working through exercise 22.1 for Stronghouse Inc. So give exercise 22.1 a try before you go through the next video. Give it a good old college try and then turn on the video and see how you did.